Okay, let's examine our next set of mechanisms to address these agency problems. So the next one is going to be debt. What am I showing you? This is capital structure by country. So this is the median leverage ratio by many different countries, across many countries. And what do you see? What you see is that there's quite a bit of cross-sectional variation across countries in how firms use debt. So what does that automatically tell you? Hopefully it's letting you know that there's not one size fits all use for debt. If you look at that picture, you see that countries perceived as more corrupt contain firms that use more debt. You also notice that countries with higher inflation contain firms that use less debt. And countries with higher dividend tax rates are going to contain firms that use more debt. The first two hopefully feel intuitive. So if the country's perceived as more corrupt, then you really worry about managers having too much cash on hand. So you might be more inclined to use debt as a way to get cash flows paid back to investors. With inflation, you're going to be more inclined to use less debt. Why? Well, that's the first thing we talked about in our first lecture. We said that a risk that you face when dealing with fixed income is inflation. And the last one may be kind of new. So here we have countries with higher dividend tax rates containing firms that use more debt. Part of this reason is because we have differences in payout policy. So if my dividend is going to be taxed a lot higher, I might be more inclined as an investor to supply the firm with debt and to receive a payment on my interest. So the above patterns that we see around the world all suggest that there's several frictions, including agency concerns, that matter for capital structure. The discipline of debt is a phrase that you may have heard before, maybe it's new to you. But the main idea is that if managers fail to pay interest and principal, the company is going to be forced into bankruptcy and the managers may lose their job. So we think of debt as being a substitute for dividends in that it's going to force managers to send these free cash flows to outside investors rather than wasting it. However, excessive debt can create its own agency problems. And they're going to first be related to moral hazard or the misalignment of our interests, like a conflict of interest. So let's think through our first example. With example one, we saw we had the case of underinvestment. The debt also led the risk averse manager to underinvest. So our focus on debt holders at the expense of shareholders means that you don't go for risky projects because they're going to lower the value of the debt, but they would raise the value of equity. Again, there's excessive risk avoidance because of this moral hazard, because of this worry about being fired if the firm goes under. You also have moral hazard that affects in the opposite direction. So we still have an incentive misalignment, but we have overinvestment. And you can imagine that if you have very high interest payments or you're facing financial distress, then as a manager, you may take on really, really risky projects with a low probability of success, but really high payouts. So you end up taking even larger risks excessively. And then the last way that excessive debt can create its own agency problems is through adverse selection. And here you can think of screening. Who would take a job at a firm that's incredibly financially distressed? A really, really good CEO or a really, really bad CEO? Maybe both. So the point is that you would have moral hazard and adverse selection with excessive debt use. Another mechanism that's proposed is concentrated ownership. So, what does that mean? With concentrated ownership, you basically have a solution to the free rider problem. So, oftentimes, companies in countries with weak investor protections may tend to have concentrated ownership as kind of a substitute for legal protection. What that means is that instead of me having a small portion of the firm, so instead of me having 2 or 3% of the firm, I'm going to have 15 or 20% of the firm as a way to make sure that the managers are doing what they're supposed to be doing. The downside of having such concentrated ownership is that you can also have what are called twin agency concerns. And here, the real concern is that some shareholders are going to be taken advantage of by other shareholders. So we think of the dominant investors as maintaining control rights in different ways. So one of the ways that they can do that is by having superior voting rights. So every one of your shares for Class B will have a voting right of 1, and every one of my shares for Class A will have a voting right of 20. We also see pyramidal ownership, which we'll look at in more detail. And then there's inter-firm cross holdings. And inter-firm cross holdings means that basically I'm in company A, I own a lot of equity in company B. And as a consequence of that, I'm basically going to have company A and B perform and behave in a way that suits me and doesn't necessarily suit all the shareholders for company A or all the shareholders for company B. So instead of pursuing policies that are going to be maximizing to shareholder value across the board, we're going to pursue policies that are going to be maximizing to my value as somebody that owns both firms. And just to be very clear, these conflicts of interest between shareholders are not limited to countries with weak minority shareholder protections. This is prevalent around the world. So let's look at the case of Facebook, which is, again, a company that's publicly listed here in the United States and has a really, really interesting ownership structure. So shares with superior voting rights are basically held by Mark Zuckerberg. Facebook has what's called a dual class structure. And what the dual class structure means is that we have a subset of shares that have higher voting rights than others. So some of the investors have the ability to have their votes count for more than other investors. Zuckerberg, executive management, and directors are Class B voters, in which one share equals 10 votes. Zuckerberg himself owns 75% of Facebook's Class B shares, which gives him control of roughly 60% of Facebook's votes. Class A, which are held by institutions and individuals, that stock has one share equal to one vote. And this is a cutout from Facebook's 14A proxy statement from 2020. What do you see? You can see that there's Class A and there's Class B. You can also see the total voting power that's assigned to having these different shares. So what's the takeaway? The takeaway is that this management strategy of having dual class shares, of having shares that have higher voting authority that are held and concentrated, it's a way of basically negating the corporate governance mechanisms that we've been talking about. And to be clear, it's not just Facebook. This is the case of Lyft. So very recently, Lyft had its IPO, and Lyft also has dual class share structure that provides voting rights and therefore corporate control to its co-founders, despite the co-founders having a minority interest of less than 10% of the newly public company. The co-founders receive 20 votes per share for every one public shareholder. And the quote from Forbes basically says that they're seeing more and more of founder-led companies going public under a dual class share structure that allows the founders to retain control while having access to the cash that's provided by the public shareholders. If you remember, we started this by motivating it and saying you go public, you sell off some of your control rights and some of your cash flow rights in exchange for capital. But what we're observing is that there are more and more companies that are going public or being publicly traded where the founder or where the management team does not want to relinquish control to shareholders. So in order to do that, they create this dual class structure. So the point is that we do have ownership concentration and we also have dual class structure as sort of these mechanisms that we observe in the market that can sometimes complicate the way that we think about corporate governance. The other mechanism that was mentioned was pyramidal ownership. And the way that this works is that we have a company that we have a controlling block. We then own another company, and then we own another company, and then we own another company. So you can kind of think of this as like a pyramid or like Russian dolls. As you get further and further away, what you observe is that with a really small claim on the cash flows, you can end up with a really large claim on the voting rights. So the example that's presented here is for Daimler Benz. And what do you observe? You observe that with just 1.56% of cash flow rights through this pyramid ownership structure of having a controlling stake in the company that has a controlling stake in the company that has a controlling stake, the investor ends up with 25% of the voting rights in the actual firm. The other one that's mentioned here are equity cross holdings. So chaebol that we talked about, where in Korea you have large firms with highly concentrated ownership that are held across other firms. You also see this happening a lot more in the United States, where large asset managers will have positions in a handful of companies. So let's move on to our next mechanism. Our next mechanism is our next mechanism to deal with agency concerns is overseas listings. What's the intuition? First, only a handful of there are a handful of commercial legal systems around the world. So all the countries have different legal systems, but really those legal systems are kind of driven and determined by 4 or 5 countries of origin. So those legal systems all have different levels of investor protections and different rights that you would have as a creditor and as a shareholder. So in this example, we're comparing Italy and the UK. Italy has a French civil law legal system, which tends to have stronger creditor protections. The UK has an English common law system, which tends to have higher shareholder rights. And you see that in the measure of shareholder rights. You can also observe that you have differences in ownership concentration. Again, in a country with weaker shareholder protections, you have much higher ownership concentration. And in a country with stronger shareholder protections, you have lower ownership concentration. And the same is true when you look at the level of the stock market and the number of listed companies. So when you have more shareholder protections, you have a bigger stock market relative to GDP, you have more publicly listed companies. So the key takeaway is that we have variation in the way that the laws are enforced and designed to offer protections for shareholders and for creditors. So if I'm a company and I want access to a better level of governance, what can I do? I can commit to stronger investor protections by listing on a stock exchange in a country with strong protections. So this is the bonding theory. And the idea is that I'm going to bond myself to the laws and the protections of another country. So if I'm in a country like Italy, then I list in a place like the UK where there's stronger shareholder protections. So we've gone through debt, we've gone through concentrated ownership, and we've also looked at the ability to list in different markets as a way of overcoming these agency problems. Our last 2 mechanisms are going to be the markets for corporate control and the independent board of directors. And again, there's no perfect solution to dealing with our agency issues. When we talk about the market for corporate control, typically we're going to be thinking of a hostile takeover, and that's going to be an unsolicited tender offer. So an acquirer is going to target a mismanaged firm that's underperforming. And it's the same intuition that we talked about with activist shareholders. If a management team is really out of control, over time, the share price is going to decline. So as the acquirer, I'm going to target the company that's undervalued because of this poor management. There are challenges to this ability of the market to sort of correct poor governance. The first is poison pills. So companies will have all kinds of statutes that make it very difficult for them to be acquired. And it's oftentimes a way of management to protect themselves from being acquired. Because we said the company gets bought, If the company's being poorly managed, you change strategy or you dump the management team. The other challenge are going to be captured boards. So remember how we said that shareholders elect the board of directors? Well, for many companies, the CEO will also chair the board of directors. So they're not totally independent. And oftentimes, the CEO has the ability to determine the schedule of appointees and to appoint people to the board. So if I'm appointing people to the board and I'm the manager of the firm, and everyone knows me and has an obligation to sort of work with me, then they're going to be less inclined to accept a tender offer or a hostile tender offer. And the other challenge with this as a mechanism is that it's the same free rider problem. So once you've done the due diligence to identify a company that should be acquired, once you make that information revealed to the public, if that acquisition doesn't go through, then they become a target for other investors and other corporations that are also looking to acquire a company that's poorly managed. The last mechanism that we'll talk about are boards. And really, what this is trying to do is to have delegated monitoring. So we've started our lecture by talking about how companies, how shareholders will elect the board. And the key point is that if the board remains independent of management, it's going to serve as an effective mechanism to curb these agency problems. But the challenge, as we just alluded to when discussing the market for corporate control, is that not all boards are independent. Plenty of board seats are captive, meaning that these are individuals that have a relationship with the CEO or that are appointed by the CEO and are therefore obligated on some level to go with what the CEO is asking. So, what's our big picture? Our big picture is that this separation between ownership and management of the firm has its good and has its bad. Because investors have control and cash flow rights, they're going to elect a board. Managers do not have control and cash flow rights. Managers and employees are going to answer to the board, and they will have what is called residual control rights over the firm. So managers have discretion over how the firm is to deploy its assets, to deploy its people, strategy, all of that, but not a claim on the cash flows of the company. The separation of ownership has direct and indirect benefits. We mentioned that because of the separation of ownership, we have diversification, we have liquidity, we also have higher market efficiency, we have more informative prices, we have more economic growth, the reallocation of capital to more productive areas. So there's plenty of benefits, but it also has some costs. And those costs that we talked about are really due to the frictions that we have in information and in contracting. So because of our frictions in information and in contracting, remember, it's very costly to monitor. The information that we have is often asymmetric, incomplete, and imperfect, and we can't contract everything. So because of that, when we have these conflict of interest and when we have our agency concerns, they can be a real problem. And remember, you should be very comfortable with the idea of the agency problem. We know the shareholders are the principals. They hire the managers, the agents to run the firm, and they're always worried that the managers have their own sets of interests. So we discussed all the different ways that agency can affect management. And then we also discussed different potential solutions to address those. So we looked at incentive contracts, the law, activist shareholders, the board of directors, all these different mechanisms. But the key takeaway is that no one tool is perfect. So we should be comfortable with residual control rights. We should be comfortable with the separation of ownership, having direct and indirect benefits, and also costs because of these frictions in information and contracting. And then lastly, we should definitely be familiar with the principal agent problem, with the agency issues that firms face internally, and then the mechanisms, internal and external, that firms have access to deal with corporate governance. Our next lesson is basically going to focus on financial options. So we've established that corporate governance matters, and we're next going to look at the corporation more closely. So we're going to get into more of our corporate finance area for the course. We're going to understand options. So we'll make sure that we have just a very basic and fundamental understanding of options. And then we're going to use those options to understand how managers can manage risk. So we'll apply those principles to currency and commodity prices, where we're headed. Once we have a good understanding of financial options and how to use them in different situations, we're going to use that tool to understand investment decisions that companies make internationally. So we're going to focus on real options, and we're going to use that to apply to our understanding of foreign direct investment. So for next week, for next lesson, make sure you read chapters 7 and 8. We're going to go through, like I said, options. And yeah, that is everything. Thank you.